Every financial statement tells a story, but not all stories are true. And that's where the auditor's report comes in, a verdict on whether the numbers can be trusted. Think of it as the final judgment at the end of an investigation. And just like in any case, there could be different outcomes. So if it's an unmodified opinion, that's a clean sheet. This is the opinion that every company wants, the all is well stamp of approval. The auditor's opinion is that the financials are fairly presented, free of material misstatements. Investors breathe easy. But sometimes the audit trail leads to doubt and could lead to a qualified opinion where the auditor is saying something's off, but it's not a deal breaker. It's a warning, but not a disaster. There could be two types of qualified opinions. First, a GAAP issue, where the company violated accounting principles, but the misstatement isn't severe enough to distort the entire financial picture. The auditor qualifies the report, saying, this one part is wrong, but the rest is okay. The second one could be a gas issue, where the auditor is unable to conduct the audit as per gas. The auditor faces scope limitations. Maybe records were missing or management restricted access. The auditor qualifies the opinion, noting the limitation. Think of a qualified opinion like a crack in the foundation, concerning but not enough to bring the house down. And then you have an adverse opinion, which is the auditor's ultimate rejection of the financials. The auditor just isn't saying there's a mistake. They're saying that the financial statements cannot be trusted. Investors panic, stock prices plummet, confidence evaporates, because if the numbers are unreliable, the company might as well be a house of cards. Then comes the most ominous of them all, the disclaimer of opinion. This is where the auditor throws up their hands and says, I don't have enough evidence to say anything at all. Maybe management blocked access to records. Maybe the numbers were too murky to verify. Maybe the auditor's hands were tied. A disclaimer isn't just a problem with the financials, it's a problem with the audit itself. And when investors hear, we don't know from the auditor, they assume the worst. And finally, there's the nuclear option. Some cases are so bad, so full of fraud, obstruction, or corruption, that the auditor doesn't just issue an adverse opinion or even a disclaimer of opinion. They resign. Resigning from an audit engagement sends one message to the world: we refuse to be a part of this. And when an auditor quits, something could be very, very wrong. An audit opinion isn't just a report, it's a signal. A verdict may be a warning. Now, an unmodified opinion means all clear. Qualified opinion means there's a problem, but not a disaster. Adverse opinion means the books cannot be trusted, whereas a disclaimer of opinion means that the auditor cannot even form an opinion. And the auditor's resignation, that's the final red flag. Because when auditors miss the signs, when they give a clean check to a company that doesn't deserve it, the damage could be irreversible. The trust could collapse. The markets could crash. The consequences may be devastating. We saw it with Enron, WorldCom, Tyco, Lehman Brothers, Satyam Computers, Wirecard, and so many others. Had their auditors issued an adverse opinion instead of signing off, billions of dollars could have been saved. An unmodified opinion is the most desired, but an auditor issuing a misplaced unmodified opinion, that's a crime in itself.